Hello everyone, this is Joe Lawrence, the Director of Strategy here at Creative Equity Group, and today we're going to cover how to capitalize on consistent returns through a buy and hold strategy. There's a lot of different opportunities here at Creative Equity Group, and today we're going to be specifically covering buying and holding and creating a monthly cash flow through multifamily investing. You know, financial freedom, true financial freedom, is defined through Robert Kiyosaki as when passive income is greater than your living expenses. So when your passive income that you're earning automatically residually is greater than your living expenses, and that would allow you to truly live the life that you want. And we're going to cover how to do that today through buying and holding, through investing your money passively into rental real estate, into multifamily investing. When we're talking about investing in rental properties and building that cash flow, typically we're buying rental properties under market value. The developers rehabbing these properties to create equity. Then they're cashing out. They're refinancing the property to get the principal back to you as the investor, and then reinvesting that money as an option so that you can move on to your next deal and you can rinse, wash, and repeat. And there will really be no limit to how many deals you could do. And we're also going to cover a little bit on structuring companies per property that get invested on to actually limit the exposure and limit any liability. So in some cases, each property will have its own entity specifically for that property. So buying rentals under market value, typically developers are going to look for value adders, properties that need a lot of work or properties that they could add units to or they could add bedrooms to. And that's going to do a couple of different things. It's going to add equity to the property, and which is going to make it easier on the refinance, which is the exit strategy that gets your principal back to you. But not only does it add equity to these investment properties, it'll also increase the monthly cash flow. And on many of these opportunities where you're getting where you may be getting a percentage of that, it'd be advantageous if the developer is increasing the value of the property for appraisal purposes and for increasing monthly cash flow. Now, ideally, the areas that we'd like to invest in are, no war zone areas. We study the micro neighborhood of that area. So you may be in an urban area that may not have the best reputation in some cases, but we're looking at the micro neighborhood, the block by block, the immediate 2 block radius to make sure that this is an area that's safe to invest in. The neighbors are, cutting their lawns, and that tenants in this area are paying. And typically, we won't buy near any vacant or boarded up houses. In fact, the only boarded up house that I want to see as a developer is the one that I'm buying. Now we move on to rehabbing these properties to create equity. There's a lot of advantages to rehabs. In fact, most traditional banks won't lend on these properties. So by working at Creative Equity Group, a developer can work with an investor like yourself and act as a cash buyer. And as a result of being a cash buyer and purchasing a property that they can't get financing on, they can get these properties significantly less than market value. Here's an example of a property. This is obviously a fire damaged property, but you can see from the before and after, this project was purchased for only $52,000, and the developer put in $57,000. Total that they were all in was $109,000, and this is purchased strictly with private money, with private investors. Now, typically, our investments are higher than this amount, but this is a deal that we wanted to show as a case study. But just put that little tidbit side note in there. But anyways, all in for $109,000, and the revenue from this property is about $3,200 per month. And with that revenue, there's plenty of money to pay all the expenses, the management fees, the upkeep, the mortgages, the taxes, insurance, everything, and still have a significant cash flow left over in every month. And that property specifically was in Essex County in New Jersey. So talk about cashing out. At this point, we're ready to pull out. We've fixed the property up and we renovated it. We got it rented. It's producing revenue. We're going to pull out the cash that's invested plus interest. And that interest would go back, of course, to the investor at Creative Equity Group that got involved in that deal. And to do these refinances, most of the developers we're working with are working with local community banks that have an interest in the area that they're investing in. And we do look at the FICO score primarily of the applicant if they're using a cash out refi as a exit strategy. It's important to know that property qualifies, but also that the investor qualifies for that end financing for that long-term 25-year commercial loan. And in this case, the after repair value of the property is $180,000. 75% of that ARV, which is what banks are lending at, totals $135,000. The all-in, if you remember from before, was approximately $109,000. So there was plenty of room and potential cash that could be pulled out of this property and still leaving a significant cash flow. Here's one of the case studies that we have on our site, a Creative Equity Group. Were bought for $82,000, invested $53,000 in repairs, and the ARV was $220,000. That gives an equity of $85,000. The rent roll on this property is $31.90 per month, and we took out the mortgage, property management, utilities, upkeep, and vacancy factor. Then the net cash flow still over $1,000 per month. The debt service coverage ratio on this property, which we don't have to get into too much, but it was well above the 1.25 that's needed. The cap rate in this area, a little bit high because it's an urban area, but we're looking at 13.8% cap rate, which is very good. And the total offering size, the amount of money that was raised, is $135,000. The principal and interest was returned to the investor within 6 months in this case study. An example as a contrast would be a residential rehab and flip. Now with the flip, we're not so concerned with the developer's FICO score, etc. We're more looking at their ability to flip properties, what their experiences are, what their references are, how many deals they've done, etc. But here's an example of a property in New Jersey where the developer purchased it for $96,108, put in $38,460 in repairs, and sold it in June 2013 for $228,000. That's a $93,000 profit, and the full principal and interest was returned to the investor in 4 months. So if this sounds like something that you may want to learn more about, or perhaps you want to get on our list so that you could know when these types of deals come about so that you could fund them and you could get involved in them, then what we want to do is have you sign up as an investor. And I can show you real quick how to do that. You just go to creativeequitygroup.com/sign up, or you just simply click the sign up link on our website, and you just simply, as an investor, you just click I'd like to invest my money, and then you go ahead and fill out the form, and then we'll be in touch with you to discuss your needs and what your objectives are. So thank you very much for listening today. This is Joe Lawrence from Creative Equity Group signing off.